Good afternoon, ladies and gentlemen, and welcome to the Science in Sport PLC Interim Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type your text in the box beneath and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Stephen Moon, CEO, and James Simpson, CFO of Science in Sport. Good afternoon.
Good afternoon. Good afternoon to everyone, and thank you for taking the time to listen to this webinar. I'm Stephen Moon. I'm the Chief Executive of Science in Sport, and I've got helping me today James Simpson, who's the Chief Financial Officer. We're going to take you through a relatively brief presentation, around about a dozen slides. We published our interim results a couple of days ago, talking about our half-one performance, and then maybe a few moments on trading in July and August. We're all very aware that this year has been very disrupted by the COVID-19 pandemic, and therefore we've tacked on a couple of months at the end to give you a flavour of the direction of travel. So let me take you to the highlights for the half one. The period being January to the 30th of June 2020. Combining our two brands, we own two brands, PhD, the premium protein brand, and we own Science in Sport, the market leader in endurance nutrition. Combining those two brands together, we delivered 23.6 million of net revenue, and that was 5% lower than the same half the year before, given the severe disruption caused in the market due to the COVID-19 pandemic. I'll take you through the breakdown of that revenue channel by channel as we go through the presentation. But to give you a couple of highlights, breaking it down at a very high level, our own digital platform, phd.com and scienceinsport.com, together with our marketplace business, which is primarily Amazon, grew 25% to £10 million in the half, and that represented 42% of the total business. And that's up 10 points versus the same period in 2019. If we look at the current trajectory, we may expect that percentage of business as online moving closer to 50% by the end of this year. Our export business grew 2% to 5.8 million. I use the term challenging conditions there. Challenging because we had quite a strong first quarter. Then in the second quarter, we were 34% down, given that the pandemic locked down a lot of our markets, Russia, Turkey, some of the Middle Eastern markets. But we are seeing a recovery, and I'll come to that. Probably the most gratifying part of the performance in the first half was, despite the turmoil, we managed to move our gross margin forward significantly. We delivered a gross margin 2.9 points ahead of the same period in 2019. And that's roughly, the 3 points came from roughly 50% of it was due to improving the commercials of our online and marketplace businesses. So pricing, less promotional discount, improved trading terms with Amazon. So maybe 1.5 points came from price. And then the other points came from improvements in the supply chain. We installed a new protein line in our Nelson factory last year. and that's performed in line with expectations, in fact, a little bit more efficiently. And then we made some good gains on buying in some of our outsourced products, such as hydration tablets and protein bars. So for us, very pleasing to see a significant movement up in gross margin. We don't think that's a one-off. We think we've got some reasonable tailwinds behind gross margin, so we'll see how we proceed. On operating loss, this time last year, we recorded an EBITDA loss, an underlying operating loss of 600,000. This year, we've narrowed it to 200,000. Now, while it's apparent we took out a lot of cost immediately due to COVID, actually this improvement in reduced operating loss is due to the superior gross margin dropping straight through to the bottom line. And then finally, on the half one highlights, we ended the period with £9 million of cash. When the COVID pandemic hit, we looked at all our disaster planning scenarios. We thought it was prudent to perhaps take some more equity cash in case the worst scenarios unfolded. We spoke to our leading investors who very kindly agreed with us and supported us doing a net 4.2 million raise. So we've now got 9 million in the bank, and we also negotiated an £8 million debt facility with HSBC linked to our debtor book. It's unused. We don't plan to use it. It was just there for an insurance policy, for example, if the lockdown had rolled on for 2 or 3 more months. So half one, in a very, very volatile macro environment, we survived. 5% lower, improved gross margin, sharply reduced losses, increased cash for us was a result given what the worst case could have been. Just moving now to give you a flavour of July and August, and the reason I'm doing this is because we're coming out of a very deep dip in April. April and May were particularly fierce in terms of downturn, and then as we've come out in June and then July and August, we're starting to see some positive trends. So I just wanted to give a flavour of that. So our July and August revenues were 1% up on last year. So August we were slightly over 4 million of revenue. We appear to have regained a quite stable base of revenues. Our digital business and our marketplace business continues to perform strongly. And you can actually see that 34% growth on July and August 2019 is ahead of the performance in the half. So you're starting to see further growth now start to come through the digital and marketplace businesses. And then UK retail is starting to show some signs of recovery. Clearly, most retail estates are now open again. So July and August versus the same period last year, 16% lower, but so that compares favourably to half one. And then exports, retail sales were 13% lower than last year, the same period, and that compares favourably to 34% downturn in Q1. And I've given a flavour of 3 markets here, not because I particularly wanted to talk about these markets, but our US business is 34% ahead of this time last year. So that market for us is accelerating. Our Italian business, we all know the terrible tragedies in Italy. Our Italian business suffered really badly in Q2, but July and August this year is 111% ahead of the same period last year, and Australia is up as well. So the message is that there's a broader recovery trend across the world, and our gross margin remains strong. Given the breadth of underlying factors. So I mentioned to you already improved trading margin coming from our digital and online business. And I gave you 2 examples of improvements in protein powder filling efficiencies and import finished product lines, and we're expecting to see a little more progress on the import products front as well. So I think our 47.7% for the first half isn't a blip, and it will slide back. I think that's a stable base to work from, and now we'll see how hard we can work to try and nudge that forward as we go. And by the end of August, our cash had strengthened further to 9.8 million. So July and August, the good news is the business is stabilized. Where we've seen positive growth trends, we're seeing more of them, and so we're heading into we're heading towards the fourth quarter. Let's see how we go. I think there are some advantages. There are some external advantages coming in Q4, which may or may not help us. And if I was to point to a couple, for the Science in Sport brand, all the cycling grand tours that we do a lot of promotional activity around are now all happening in September and October. So the Tour de France is still on now. The Giro next, and then Vuelta. So there might be a bit of promotional interest around the big cycling tours. And then Amazon didn't run their usual Prime Day, June or July. That's now going to run early October. So in Q4 we will get Amazon Prime Day and Black Friday. So there are some decent environmental factors that hopefully we can execute well and have a reasonable quarter for. So momentum on all the key areas moving in the right direction. So now if I go back to half one and break the business down by its various components. We drive the growth model of the business with a flywheel of innovation, brand, e-commerce, world-class customer service, and supply chain. So if I just go around the most notable elements of that now, for the last 5 years, 25% of annual growth has come from innovation, come from new product, and that continues to be a strong source of growth for us, and will be particularly so in quarter four and looking out into next year. This year, our sales from new products in the first half grew 8%, and that was deliberate. To be perfectly honest, we had a lot. We had the pipeline loaded with a lot of innovation, but what we didn't really want to do is start firing good new products into the lockdown when people were more interested in buying toilet roll and dried pasta. So we held some innovation back. Our PhD plant powder and our PhD smart cakes had launched just before the lockdown, and they've gone very well. And then since then, we've started to roll out some of the newer innovation. So I've got an example there. Science in Sport launched Turbo Plus, which is the world's first sports nutrition range designed specifically for indoor training. So you're seeing the rise of Peloton and Zwift. So it will help people who train in an indoor environment, and it's got some novel technology in, so it's got a patent pending. And the early signs for revenue and growth on that are pretty strong, so we're pleased with that. Looking to the end of this year and into next year, we're currently installing new equipment in the factory. Later this year, at the end of November, we will start manufacturing protein powders in the world's first fully biodegradable protein pouch. And that will launch in market in quarter one of next year. So quite an innovative move on packaging that will put us ahead of the game. And in 2021, we've got very strong pipelines coming through for both brands. We've got big extensions to the diet whey range for new usage occasions and new exercise regimes. And we've got a brand new carbohydrate technology, which is currently being used in the Tour de France, and which we're going to launch commercially next year. So innovations in very good health right now. Moving to brand, looking at two brands separately. So PhD, if we look at the PhD brand sitting within the protein sector, the brand had grown around about 7% CAGR prior to us buying it for several years, and we bought it, and we started to invest in brand equity last year, and growth went up to 23%. Top line growth was 23% last year, and brand awareness and brand consideration and brand usage flow through to real sales in the end. So this year, our awareness from PhD has gone up significantly to 40%, consideration to 30%, usage 20%. And you can see the conversion. If you're aware of the PhD brand, 3 in 4 people are going to consider buying it. And of the people who consider buying it, 2/3 of those people are going to buy it. So investing in brand and investing in equity is a very important important component of our business model. So we're pleased with that. You'll note in the notes on the right hand side that brand awareness for PhD spikes to 47% for online purchases of sports nutrition. That's very pleasing given the significant emphasis we're giving to our online channels. So within the protein sector, the recently listed Hut Group's My Protein brand is the 800-pound gorilla in the room, and that leads with 61% awareness. We have very rapidly caught up to Grenade, manufacturers of the Grenade protein bar range. We've very quickly closed the gap on that brand, and obviously internally our war cry is to pass them as quickly as we can with our full range offering and move into a strong number 2 challenger position. So that's our plans. We were pleased with progress within the protein category. If I move to science in sport in the endurance category, My Protein is the brand that people are most aware of, and just to explain that anomaly, so most endurance athletes will use a protein powder as part of their recovery or lean mass building at some stage, and so they're aware of protein. And if you're aware of protein, you're aware of My Protein. So they get the highest awareness. But when we go to the pure play endurance category players, we're the leader in the category. The second brand is High Five, which is the Associated British Foods endurance nutrition brand. So they're number 2. And then we've got a long tail of smaller brands sort of straggling behind. But if you look at endurance category, you would have to look at science in sport, and you would have to look at High Five. That's not me sort of putting blinkers on and ignoring My Protein, but their awareness comes from slightly different factors. So both brands sitting very strongly in both the protein and endurance nutrition categories. So that for us as a management team is we believe in brand equity. We've consistently invested over the years. Consistent investment results in awareness. Awareness eventually converts to usage. So we're pleased that our model works. Just looking at the components, the brand quality components. So on the left-hand side, here's PhD compared to My Protein, Grenade, and Huel, the meal replacement brand. So My Protein, Grenade, and Huel are 3 big and strongly growing brands. And if you look at our brand, it's number 1 in all the key categories. So it's well designed, the packaging's appealing, it's a trustworthy brand. We're always innovating, and we have superior quality. So there's a lot to like in that section. And then when we go over to the other side, if we look at science in sport, and we've picked a couple of big brand names, the awareness leader My Protein and Power Bar, which has got very good awareness, even though usage is low. We're well designed. We always innovate. We're a brand for endurance athletes, and we're superior quality. We've got one amber light there. We didn't like the packaging looks appealing. The packaging looks appealing. That score has consistently been the sector leader for the past 3 years. So We're not sure if that's an anomaly, so we're going back to check that data. I'm not overly concerned. It could be a statistical anomaly. But again, Science in Sport stands out as the high quality brand, and certainly when we go and talk to elite athletes in sports around the whole world, actually we're seen as clearly the premium brand in endurance nutrition. So the brands are in rude health. We'll continue to invest hard consistently to keep them in that sort of a shape. Now let's look at our online business, both our own digital platform and our business in Marketplace. And Marketplace, for the purposes of this discussion, is Amazon. So our goal was really to push to around about 50% of the business being online by the end of next year. So you can see the COVID effect seems to have accelerated that a year. I've been doing my institutional investor roadshow in parallel with the kind of meetings like the one I'm doing now with you gentlemen and ladies. And the question keeps coming up, is this volume sticky or will it run back to retail? The data that we're looking at in-house, and don't take this as gospel, it's just our in-house take, is that it appears to be sticky, that once people have got into the online habit, there isn't really a great deal of incentive to go back. I can imagine the impulse buys like protein bar at the side of the till or in a forecourt. I can see that still. I can see that market still performing well, but I can't see if anyone's had their 2 kilograms of protein delivered by Amazon Prime. I don't know why they'd want to lug that home from Tesco anymore, but and we can see that in some of the data we've looked at. Our medium-term goal is we'd like to turn this business into maybe two-thirds online globally, probably by around about somewhere in the 2022 to 2023 region. So we were going to become a predominantly online business, but that's not to diminish the role of retail. Retail's a great mechanic. It's profitable for a start, and it's a great mechanic for product trial and product awareness. So we will never be totally online. That's never been our intention, but pushing towards online gives us a closer relationship directly with the consumer. So at a very high level, that's the shape of the business. If I go and look at our digital business, it grew at 25% in the half. PhD.com is a relatively new business. When we acquired the brand, it didn't have it wasn't a .com brand at all. We didn't have a database to start with, and we had a website, but it wasn't the best in the world. So we put in place a new trading platform last year and started to build a database. The good news from that is the new platform works well, and the good news is we've gone from a database of 0 to 180,000 as of today. The guys are telling me they want to get out the year with 190,000 people on the database. I really like round numbers, so I'd like to see a 2 on front of that. That will give us a nice platform going into 2021. Conversion is up year on year, so 5.25% conversion is good, and our average order value is also up 9%, and we're showing a £26 average order value there, but that's fully diluted by promotional offers. So actually the underlying basket size is even more healthy than that. So PhD.com, good first half. I've already pointed to the July and August figures, that it gained further momentum in July and August. Looking at the macro environment with 2 massive online trading events in Q4, let's hope that we capitalize on both of those. And then scienceinsport.com is a slightly different story. Scienceinsport.com in the half grew at 6%, which is well below what we've been used to. And it was much more strongly affected by lockdown. So when the hard lockdown went on, people weren't sure whether they could cycle or not. All the big cycling sportives, Ironman events, triathlons, big running events were cancelled. And so our consumers went into a bit of a lockdown for that period that from sport, as well as having to work from home and whatever. We're seeing the numbers recover very healthily in Q3, so we're not downhearted. And again, as mentioned earlier, big sports events coming back to some extent in Q4, plus 2 big online trading days. We're optimistic that we can turn that around as the year goes on. So not where we wanted it to be, but conversion was up. Average order value was up almost 20%. So the underlying metrics were very strong. We've taken the worst that lockdown can throw at us, he said, hopefully, but and we've come through that. So rest of the year and moving into 2021, big hopes for our digital business. Now moving to marketplace. Marketplace statistics in general, they're in the bottom left-hand corner. So for the half year on year, traffic was up 39%. Conversion, so people who come on our Amazon page and look at our product, 19% of them converting, which is tremendous. And our average sales price up 5.5%. Now, if you look at the right-hand side, it says 22% year-on-year growth. But just to be really clear, that 22% year-on-year growth are our sales into Amazon. And Amazon fully loaded their supply chain at the end of last year ahead of January. And then they continued to fully load it at the start of the year ahead of the season. And January was quite soft in general. And then, of course, COVID hit. So Amazon's supply chain was fully loaded with inventory. And what we're seeing as the years progressed is that inventory started to unwind, and we also track Amazon's sales out to consumers. So we track our sales in, Amazon's sales out, and I've given an example there. Sales out of USA Amazon are up 72% year on year in half one. And if I look across all the sites, for example, the UK, which is our biggest site, if you look at the sales out, this is very significantly ahead of last year. So looking at half two, we would have to be optimistic because the inventory is clearing out, or is cleared out of the Amazon pipeline. And we're looking at that very strong double whammy Prime Day, Black Friday, Q4. So marketplace in general for this year, we're bullish about, and marketplace in general for next year, we think is going to be a very important source of growth. It's now, we completely retooled the Amazon team internally. Earlier this year, we brought in external recruits from who were digital and marketplace experts in big players around the industry. So we've got a new team in place. We've got better trading terms with Amazon. We're seeing strong sellout improvements year on year. So marketplace for us is a strategic driver. I think I mentioned I was asked on another call I've done in the last couple of days, is it profitable? I think there's a sort of myth that Amazon's algorithm sort of crushes everybody. I think that can be the case, but if you've got a sort of couple of premium brands that have got reasonable market share in the market, then Amazon are very open to collaborating and working on joint business plans, and we're seeing the fruit of that. So we're very bullish about marketplace. Looking at retail, you would expect to see a lot of red ink on this page. It's very important for us to protect the retail business. The reason we want to protect the retail business, it's fundamentally very profitable at a trading contribution level. And we split it down into broadly 3 areas. So our grocery business, we're actually quite a prominent player in grocery. And you can see the net results from that in that year on year in the half, we saw a 5% decline across the grocery estate. And so that could have been a lot worse. We're securing new distribution in Aldi and Lidl, and that's profitable distribution. And then if you look at the more established traditional retailers, your Asda's and your Tesco's, we've actually got quite a prominent position there. Grenada in there as a big single category offering in protein bars. But if you look at companies that can offer the full range of sports nutrition from, for example, isotonic gels through to protein powder and bars. We're actually the biggest player across both of our brands, and we're double the size of the number 2, which is Cymex, and we've surpassed surpassed legacy brands such as Maximuscle. We've got the top 2 selling protein powders in Asda and Tesco, and our PhD Smart Bar is the number 2 and fastest growing protein bar in the market. So we're not without some scale in the channel. So clearly, the big retailers are having a reset and thinking about the future and looking at everyday low pricing. We're working with them very closely on that. You can imagine it's quite a robust discussion. But equally, the UK grocers aren't, they're not daft, they're successful, they're not daft, and they're very high on exciting their customers with innovation. And I think that's I think that's our advantage. Not only are we a full offering player, we're also a market leader in innovation. So the innovation conversation is helping us greatly in UK grocers. When I look at the outsider grocers, UK's high street, for us, Holland & Barrett is Holland & Barrett is our biggest customer on the high street, and they clearly took a big whack in Q2 because stores had to close for a while. So, but to Holland & Barrett's credit, they've been driving hard their Holland & Barrett online business, and that's going very well. We can see that in our orders out, and their EPOS data, their sales out data shows that the consumer's coming back and shopping now in Q3. So we're starting to see between their retail shops recovering and their online business booming, we're starting to see a good recovery there, and that's very heartening indeed. Heartland for us, our biggest player there is Madison, and they're the Shimano distributor for the UK, who distribute to cycling shops, and then we've got some protein wholesalers in there that took a very, very serious whack in the first half, 45% down. Again, we're seeing some of that coming back. We're seeing some of it not come back. So clearly some smaller retailers and some smaller third-party online players have been terminally damaged. We're seeing Heartland coming back, but I think it's going to be a very, very long haul to get back to parity, if we ever get there, given the inroads online are making. And then the third leg of that is third-party online players. So we sell to some third-party online players as though they were a retailer. So we sell to them. We don't have any input on marketing. They do their own thing. Wiggle, the cycling, running, triathlon, swimming activity website is easily our biggest customer in that area, and they're in very strong growth in Q3. Very strong growth. It's not my data to give away, but thankfully they're seeing the same online boom, and that's helping us. And then finally, export. Q1 went very well. Q2 we got a massive whack. Q3 at 13% down for July and August. And we're going through a strategic review there. We again, around the world, some of the smaller regional distributors have taken very heavy hits, which may in some cases become terminal hits. So we're looking to deal with fewer export distributors and do more work with them and focus on bigger markets. So Italy's a big market for us. Germany's a big market for us. Spain's a big market. We've got a very, very good distributor in Russia. He's weathered the storm very well. So we've got a very good distributor in the Middle East, in the United Arab Emirates, who's also servicing some Middle Eastern markets. So you're probably going to see our export business coalesce around fewer but more substantial exporters. Our overall goal here is firstly to be realistic. Does any sane individual think that retail is going to go through a golden period right now? Probably not. But we're going to battle as hard as we can to get that whole retail estate, back to as close to level as we can. The reason being, it throws off so much profit, which we then invest in our online business. So they're all the three legs of our trading operation. I'm going to hand over to James, who is our Chief Financial Officer. He'll take you through the financials. He was having a couple of tech problems early, so you might need to turn your sound up for this one. He's not normally this quiet. So, James, over to you.
Thank you, Stephen. I'm talking loudly, so hopefully everyone can hear me. I've just got 3 slides to run through, which really pick up the points that Stephen's made at the start of the presentation and put some numbers together on them. And again, if you need more information on this, you can find the full RNS statement on our website. The key thing to call out on the summary income statement, on top of the revenue that Stephen's already talked us through, is a strong improvement in gross margin, which was up nearly 300 bits, half one versus the same half in 2019. You can see that we managed our sales and marketing costs broadly in line with our revenue and kept our admin costs flat over the half. As a result, we were able to more than halve our underlying EBITDA loss from -600 in half one to -240 in half one this year. Moving on to the next slide, this shows a breakdown of that same P&L over the 2 brands. You can see that the gross margin increase applied to both brands over the half, and indeed, as Stephen said, the revenue growth was roughly similar for both brands, despite their different markets and customer base. Sales and marketing costs were higher for PhD brand due to the decision to invest heavily behind the phd.com opportunity and grow the database that Stephen referred to earlier. In terms of the underlying EBITDA for PhD as a result, that was broadly flat at 1.2 million, and all the improvement came through in the SIS brand, where we saw the underlying loss reduce by around $500,000 from half one last year to this year. The final slide I'll talk you through is cash. You can see a significant increase from our opening cash position of 5.4 million to our closing cash position of 9 million. This was due to the equity raise we did in April during this year as a precaution against the impacts of COVID. However, excluding that 4.2 million, you can see that cash was slightly down over the half, primarily as a result of the investment in capital expenditure, most of that being in technology to support our online platform and drive future sales growth. Thank you.
And then I'll just move to my outlook slide. So looking at the rest of the year, and then answering some of your questions. And actually, I've got a list of very good questions here. And I think my final slide in these questions sort of cross-fertilize a bit. So if we look at the year in general, so COVID hit, and then the first thing we did was get into disaster planning mode. We came up with a number of scenarios which might hit us. We took some significant moves early on. We took salary cuts around the whole business from chairman downwards, and they've been in place for 6 months now. Sadly, we had to let around about 12% of our headcount go. We took out some marketing costs. We took out some what James would call non-strategic overhead. James calls everything non-strategic because he just wants to get it out, to his credit. So we very quickly got into let's survive mode. And then once we'd done that, we raised some cash. Our leading investors were very supportive, and for that we're very grateful. So we did that. And then we got on to looking at the future again. So we thought we didn't want to lie in the fetal position for 6 months. What can we do right now to become a leaner, meaner, more fundamentally profitable business? So we've spent a lot of time doing that, and I'll mention some of it on these slides right now. We've already talked about science-led innovation and strong brand equity. They will always be continued growth drivers. We're in a sector where commoditization is an ever-present risk, and we've got the 2 most premium brands, and that's been consistently measurable, and we're going to stay that way. So we're just going to keep doing that. But moving on to supply chain technology. I've got Steve here has asked me a question about, we've strengthened the balance sheet, and secondly, we wanted to support future high growth. At what stage will we move those funds towards high growth and not being defensive positioning? And so that brings me to Steve's question right now. If we're not the largest isotonic gel manufacturer in the world, we're very close to it. There could only be one other company based in California who could be the size of us. We're almost out of gel manufacturing capacity, and it's an extremely profitable piece of business for us. So the board of directors approved back in March the purchase of a new gel machine, which by our reckoning will be the largest gel manufacturing operation in the sports nutrition sector in the world. That will be in place at the end of next year. So there's an investment going on there. And secondly, we have been in our Nelson factory since 2013 now. The footprint of that factory has grown 37%, and in the meantime, we've grown revenue ninefold. So the board of directors meeting on Tuesday of this week approved the building of a new factory, reasonably close to our existing factory. At the end of 2021, we will move into a £150,000 square foot factory in Leyland in Preston, and that will enable us to consolidate all of our manufacturing, including the new gel line, all our logistics, a significant space for expansion of our digital logistics operation. So that's going into play. If I look at both of those two projects together, the overall cost slightly over 4 million. So not a massive outflow. And of that, we're probably going to work with our bank to finance possibly slightly over half of that. So around about 2 million will outflow at some stage from that. But the payback on both of those projects is incredibly quick. It's around about 19 months payback for both of those projects. And of course, our plan is, by the time we get to this time next year, hopefully we're generating enough operating cash to service that in any case. So massive shift and step change coming in supply chain, a plant that will give us in its first iteration the capacity to grow to over 100 million revenue, and then we've got a phase 2 which will enable us to grow closer to 200 million. So we're planning for the next 10 years. And then the other piece of investment, you can see very clearly that the digital business for us is a massive strategic focus. And the next step change there is we've invested in people and teams, and we've done some work on systems, and we want to start investing more heavily in technology to improve our engagement with customer and to drive to step change all those key metrics on the digital business. So that is our next big push. You've already seen, because James has presented our balance sheets in good order. So we're very happy to fund these massive growth-related projects. So overall, in Outlook, we're very optimistic about our long-term profitable growth curve. We've got a proven strategy. You can see from the numbers and where we sit on cash that what our cash situation is. So we see before us that we can 2021 really push on into a profitable growth strategy. There's the usual disqualifier. Disclaimer. Nobody knows if is there going to be another lockdown? Is there going to be a wave 2 or wave 3? And what will that do? But all we can do is plan for the known. And the known for us is the business is in pretty rude health. So that was my presentation. I'm going to take these questions here right now.
Perfect. Stephen, if I could just interject just to give you a time, because obviously there's a number, I think if you look, that have come through, and also we've got some pre-submitted questions, if that's okay.
Yeah.
Is that all right? So ladies and gentlemen, please do continue to submit the questions using the Q&A tab. But I'd like to also remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. It's also important to note that feedback is important to the company, and immediately following this presentation, you will be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectation, and would very much encourage you if you could spend the time just to provide them your views on the company. I guess obviously, as I just suggested, investors have had the ability to pre-submit questions ahead of the event, and I'd like just to propose those, and obviously these can be published as well. The first question is, I'm a retail shareholder and user of your product line. I found that during lockdown, I've used less supplements due to a drop in training intensity and lack of racing opportunities. How has the lack of competitive opportunity affected sales, and when do you see some kind of normality? I know you've kind of touched on that, but I just wondered if
I can come to that specifically. So it's a game of two halves, really. So I think I indicated that science in sports, because of its focus on outdoor events and people training for marathons and sports teams, took a heavy hit in April and May, but it's on its way back to health. And then the pleasant surprise, which was unexpected, people assumed that the gyms were closed, so people weren't going to buy protein products. And actually, so we went out and we did a piece of bespoke research with consumers. And what we found was people buying protein products and nutrition supplements actually increased their consumption during that period. And 1 in 3 now say that they're buying nutrition products online. And then the second piece of data was 49% of people said that they exercised more. So this is sort of indoor training, training in the park, strength-related training. 49% of people said they trained more during lockdown rather than less. So that underpinned consumption. Whether they did or not, I don't know, but they thought they did. So that'll do for me as long as they're buying PhD. So yeah, game of two halves. And SIS is coming back very strongly, and PhD hasn't really missed a beat.
Perfect, thank you. Just two further pre-submitted questions, and again, apologies for, I know you've touched on certain elements, but what are the key drivers behind the growth in your e-commerce platform, if you were to pick out a couple?
Yeah, we've invested heavily in building database, so that's driving it, and then in the last few months so we drove hard on this. It's always been a very profitable business for us, but we drove very hard on investment to build databases for both our businesses. So we wanted to build database, and I think we've done that successfully across the piece. Between both our websites, we've got around about 700,000 consumers, which is a sizable database and growing. So that's driving it. Yeah, and we've invested consistently in marketing, and so we invested consistently in marketing, but we've been able to give our pricing a more robust approach. So some price increases have gone through, and we've reduced our promotional depth quite a bit. So the business is fundamentally more profitable at the gross margin level. So having that gross margin available gives us flexibility to push hard when we need to and back off when we want. So between database build and making both businesses intrinsically high margin have been the growth levers for us.
That's great. Thank you very much. And finally, a question really around expansion and opportunities. Are there any new territories that you see the company expanding into, and or any new sports for partnership opportunities?
We're always looking at new. If we look at the last 12 months, for example, we've expanded into some of the Latin American countries, Brazil, Colombia, Ecuador. Clearly, so, you know, some of them had a stuttering start because Brazil's been massively hit by COVID. So we looked at Latin America. We've got a presence in North America. In the Middle East, we've expanded recently into Saudi Arabia, for example. So we've got a good Middle Eastern footprint. Our Russian distributor, great job. We now, our next port of call is to really push on in China and Asia in general. So China, both China and Japan look like very fertile opportunities for us. And we've got some level of presence in China, which is growing. It grew quite strongly for PhD this year. It grew 38% on last year in the half. And then Japan, we've just put our first foot on the ground in Japan, and we're going to have a go there. So I think we've covered key markets. And so I think you'd see us present in Asia as the next step.
Thank you very, very much indeed. As you quite rightly mentioned earlier, a number of questions have been submitted by investors today. And perhaps I could just ask you, because no investor can see another one's question, if I could ask you perhaps to maybe start at the top and I'll track with you and perhaps read out the question and a response where it's appropriate.
Yeah. So question one from Andrew: can you advise what level of market share you have in the UK, and can you grow the share any further? I can't give you share percentages. I think that's a fool's game because the sector isn't that closely monitored by the market research companies. So it tends to be, the data's quite often spurious. So what we tend to do, and I've already shown you the slides, we measure our position in the market by brand awareness. So brand awareness always turns to usage in the end if you get your conversion funnel right. So the fact that over the last years our brand awareness has been growing steadily, for me, says we're taking share. And I think that's a lot more accurate than trying to dissect who's selling what in pounds. And is there room for more? Of course there is, because there's a massive long tail of smaller brands behind us, and there's a big gap between us and MyProtein. So that to me tells me 2/3 of people aren't using Science in Sport, so I'm going after them, and 60% of people aren't using PhD, so I'm going after them. So yeah, there's a massive amount of expansion potential in the UK. I'm very profitable because we got the platform. And then it looked like the next question, it looked like you plan to do some heavy stock line rationalization. Can you say a little more on the background to this, and do you think it will cost you much revenue? We had 2,200 stock keeping units at the start of the year. And by the way, that's not abnormal, because if you look at some of the big online protein players, they've got well over 2,000 SKUs. Some of that had come around from us giving a wide range, but some of it had come around from our expansion into different territories and different language packages. They all count as a different SKU. My personal experience and looking at good case studies around industry in general is that SKU rationalization never reduces in lost sales. And we went through a big SKU rationalization with SIS maybe 4 years ago, and sales went up. When we did the analysis, we've got an excellent new supply chain director, joined us last November. When he looked at the analysis, I'd like to say it was Pareto, but it was worse than that. So about 2,200 SKUs, actually 90% of the sales came from a very small percentage of those SKUs. So we think we can rationalize those SKUs, get focused around our big franchise product lines, reduce inventories, improve our working capital profile. We've got 1,000 SKUs out in fairly short order, thanks to the commercial team and the supply guys. And our target is to get below 700 SKUs by next May or so. If there's any of my guys listening now, they'll be cringing because they said June, but I'm always a bit vague on dates. I can always find a way to pull one forward. So massive rationalization, absolutely the right thing to do. Think it will boost sales, will definitely make us more working capital effective. Steve, I already answered Steve's question in the Outlook slide. So he is asking me at what stage was the funding we raised going to turn to growth? And the answer is obviously supply chain and technology, and then consistent growth in our digital platform. Brian asked the question, which of your products are in-house and which are outsourced, and how do margins compare? And any plans to shift the mix? I would say roughly, probably slightly under 20% of our products are outsourced. Of course, our in-house margins are superior because there isn't a toll manufacturer to pay. Nevertheless, they're outsourced for a reason, that reason being those manufacturers have a specialist expertise. So like such as a multi-layer chocolate coated protein bar is very specialist, and to manufacture an effervescent tablet's very specialist. Both of those lines, both the key suppliers in those categories have worked with us to improve our input prices, and that's flowed through to growth. So yes, we've got products outsourced. Do we have any plans to bring it in-house? No, we don't. We're very happy. It's a very profitable business. Horses for courses. We'll let the specialists do what they do. Peter asked me a question. I may have missed some lines, but on a glance, I thought the SIS vegan protein range wasn't great. I'll send that to the marketing guys. I don't know about PhD. Is this because SIS targets elites rather than lifestyle? Is the vegan market a particular target for you? Very good insight. You must have been sat in some of our product development meetings. The Science in Sport plant range was primarily developed with the elite athlete in mind. For example, every championship football team has got 3 vegans on the squad. So we needed to produce a vegan range for elite athletes because there are more and more elite athletes using vegan products. So it's been a relatively niche line for us, but we can't be the world's leading supplier to elite athletes if we don't jump when they speak. So they spoke and we gave them the SIS range. Now, PhD, completely different story. We launched a plant range, I got to say, April of last year. It's a tremendous business for us. It's growing, I wouldn't say exponentially, but yeah, the growth curve is pretty vertical, and we're capitalizing on that. We've got more and more product line extensions coming out in Q4 of this year and moving into Q1 of next year. So plant products are a very, very big business for PhD. I don't think it's a trend. I think it's a macro trend. It's here to stay. We've got a brand and a product that's well positioned to take advantage. So I'd watch this space on the range of innovation we're going to bring to that. Peter also asked me, do you think there will be consolidation amongst the various brands? And if so, how will it leave the industry after? I think that's a very insightful question. Yes, there will be consolidation. If you look at any particular market around the world for sports nutrition, whether it be endurance or protein, what you'll tend to find in each market is 2 or 3 market leaders, and then a very long tail of follower brands. And you can see that in the UK, for example, you've got MyProtein, PhD, PhD Grenade, brands like Optimum owned by Glanbia Protein, and a very long tail of smaller brands. Smaller brands, particularly smaller brands who haven't made the transition to digital selling, they're under some stress right now. If I look at the endurance sector, SIS clearly the market leader, ABF obviously with very deep pockets and very patient people, high fives there and will remain there. But again, a lot of smaller endurance brands in the UK, around Europe and around the world haven't made the transition to online. They're under extreme pressure now. I don't think all will make it through the COVID crisis. I think there will be a consolidation. I think you'll see the tail disappear in a lot of markets. And I think you may see some brands come together. For example, we put what we thought was the best endurance brand together with what we thought was the most premium protein brand, and that's gone well. You're probably going to see some of that again when we get on the wrong side of COVID. So I think I expect change. Is there a trend towards or away from RTD? I'm probably going to be controversial now. Ready to drink in proper for your serious endurance athlete, ready to drink has never really stuck. You're talking to a guy who works on Lucozade for 5 years, so I know ready to drink for the endurance athlete. It's never really caught on for the endurance athlete. People are very particular about what blend and what level of carbohydrate, and so I don't see RTD being a major play. History might prove me wrong, but it hasn't happened in a few years, and I don't see any credible option. And by the way, if you want to be an endurance player and go into ready to drink, you better be ready to take on Coca-Cola, PepsiCo, and Lucozade head on, and that's not a game you want to play. And then in protein, for me, there's only been one big example in the world, and that's the American brand Muscle Milk, which went through a huge boom a few years ago, and is still around there. Again, you see brands, including PhD, by the way, that have launched ready-to-drink products, and it sounds like the right thing to do, and logically it all stacks up, but they don't really stick and succeed. You never really gain scale. So my long rambling answer is, everyone's always going to keep trying RTD, and I don't rule out, I never say never to us having a go again, but you've got to listen to your consumer, and over an extended period, if they're a serious trainer, they don't really take to ready to drink. And then Matthew asked me, is SKU availability back to normal yet, or are you experiencing some disruptions? So you clearly look at our website and see out the stock lines. There has been some disruption, and there have been disruptions related to COVID and the supply chain, and things like maltodextrins for gels come from France, and there have been some issues there which have now been resolved by a couple of routes resolved. Things like the Go Hydro effervescent tablets. Every manufacturer in the world got nailed by a massive consumer rush towards immunity tablets, and poor guys like us in sport got left behind. That issue has been resolved literally this week, so you will see the Hydro stuff come back into stock. They've been our two biggest hits. They were blips. We're now stockpiling. Now all those key raw materials are back in stock. We're now stockpiling them. Firstly, there may be a second wave of COVID. Secondly, we've obviously got a Brexit of some sort or another coming up. Watching Boris Johnson, it looks like about as hard a Brexit as you can get. So we're prepared for that. So apologies for a period of some out of stocks. We are now back in stock. And we've built the war chest to keep us going through whatever the world has got to throw at us next. And that's the final question. Thanks. And thanks for those questions. There were some pretty high quality questions there. So thank you for that. Stephen, that's all my presentation, and those are all the questions answered. Thank you.
That's brilliant. And just to remind investors that these will be published on the platform as soon as appropriate afterwards. Perhaps I've given you about 30 seconds breath space, but perhaps I could just ask you to wrap up. And I know that feedback is important, and we will direct investors to provide that for you. So if I could just ask you to wrap up, that'd be great.
Yeah. I mean, just to quickly wrap up. Firstly, we're pleased with where the business is. It could have been a lot worse. We're pleased that not only did we move through the first big hit of COVID, we're a much healthier business. Secondly, thanks to everyone for coming and listening to the presentation. I think Science in Sport's an undertold story. You can see that in the valuations. So this novel new platform gives us a way to reach out directly to private and retail investors, and it's something we haven't been able to do before. So we think we've got a value story here, and so thanks to the guys at Investor Meet Company, I think this is something we'll be using regularly. So those are my wrap-up comments. I appreciate everyone's time, and hopefully we'll talk again soon.
That's very kind. Thank you very, very much indeed for updating investors today. Could I ask you not please to close your session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this via our platform, then you will be having the feedback page appear in front of you. Alternatively, you'll be asked to log in just to provide feedback. So on behalf of Science in Sport and the management team, I'd like to thank you for attending today's presentation. That now concludes today's session. Good afternoon to everybody.